So today one of my stocks is absolutely skyrocketing in pre-market and it's making a big move, and I've got to say, I did tell you guys. I made a video a few days ago saying that this is more than likely going to happen, and I gave you a bit of a warning, so don't say I didn't warn you, but we'll take a look at that stock. And as well as that, we've got some inflation data to go through, and also we're going to look at a sector that I'm looking at, trying to find a stock I like in here, because I think this could potentially be an interesting sector for a turnaround in the next 2 years. So yeah, I hope you enjoy these 3 topics we're going to cover today in this video. Hit that like button, let's get started. So right now as we're recording this video, one of my stocks, PDD Holdings, is up 13% in pre-market. These guys own Temu, and as you guys know, I have been talking a lot about this stock in the last few days. Around about 7 days ago, I made a video saying PD Holdings, Pinduoduo could 2x in 2024. I don't normally make short-term predictions, but I felt very confident on this one because I was looking at a lot of the stock charts in the world and Temu was still absolutely smashing it. And that gave me a lot of confidence as well with the last beat on earnings and the valuation it's at, that this stock is going to do very well. Now, since I did make this video 7 days ago, the stock actually did bottom out, and you can see here the stock is already up 15%. With today's move, that's going to be up over 30% already. So yeah, that's a very good run from when I made this video 7 days ago. As well as that, you guys on the Patreon know as well that I actually doubled up my position in Pinduoduo during this dip here. So today my position is going to look very green as the stock opens up, which is absolutely amazing. And if you do want to know when I'm buying and selling companies in real time like PDD Holdings, then join the Patreon, links in the description, £5 a month. If you had put £200 into PDD during that time frame, you would have made your Patreon subscription up for the year already, which is obviously very good. So like I said, we don't normally focus on the short term, but it was one that I was very confident on when I looked at the valuation and the previous numbers. So yeah, well done to anyone that did take advantage of PDD Holdings in that dip. And obviously, even though it's good in the short term, I'm sure in the long term as well, this stock will do very well. So yeah, very good jump in pre-market. Looking at the earnings, very good. I don't want to keep it too long because, like I said, on the Patreon, I'm actually going to do a breakdown of the earnings a little bit later on. So I want to leave a lot of details for that. But briefly, I just wanted to say, yeah, really good numbers. I mean, EPS was a really good beat, as you can see here. I've got to say, a lot of people aren't appreciating this. It's already at 22 forward times earnings, but the fact they're driving up profitability more and more and more, this is actually a bit of a false forward PE. The forward PE is actually going to sit more in towards the teen range because of how quick the profitability is ramping up. And you know, you're going to be paying a teen range forward PE for a company that's growing at 123% year over year, and they just beat by 1.6 billion on a 12.5 billion revenue business. Or revenue income on that quarter. That's no small beat. That's very impressive from the revenue point of view and the top line point of view. And like I said, it's going to be trading more towards the team forward earnings. And you know, I look at this stock realistically, and I could argue the case this stock should be up a lot more today and than what it already is, which is obviously a really positive sign. So yeah, really good numbers from there. But don't say I didn't tell you. Next thing I want to talk about really quickly is the UK inflation news. The UK inflation came out, and it was actually pretty good data. The previous month was 4%, it actually came in at 3.4%, and the expected was 3.5%, so a 0.6% drop in inflation was pretty impressive. Now, it was a little high, a lot of it was still due to food. It seems like the supermarkets have been a little bit greedy during this time frame, isn't it? But food's still a little bit high, that's keeping that inflation up, but overall, the trend is still there. The trend is our friend, and it's moving very much in the right direction. I think this gives even more support that I think the UK are going to go before the US and cut interest rates first. And the other thing as well is that when you look at the next set, not March's set of data, but when you get to April, we're going to have the next energy price cap coming down, and that's going to save another £238. So this is you know, whenever we have a drop in the price cap, this is a big reason for why we see big drops in the inflation. So I generally think that the UK is actually only 2-3 months off this 2% mark, and I don't know, we could actually get there before the US, which would be absolutely crazy to say. No one would have thought that a year ago. And like I said, I think the UK is in a position where they can afford to probably jump before the US on the rate cuts. You know, we've done a lot of copycatting off the US. I think we can afford to do it. Our economy isn't in a good place as the US economy, but inflation seems to be coming down quite well. You know, I think that you must be thinking, maybe we jump before the US on this one. I don't know. That's what my feeling is at the moment. But what surprised me is that this was pretty good news for the UK. But yet when you looked at a lot of UK stocks today, and I was talking about this on the Discord, which you get access to when you join the Patreon. On the Discord, there's a lot of members on there, and I was talking, saying like, what's been surprising is this is really good news for the UK, and the news has been getting a bit better for the UK recently. It's still not amazing, but it's getting a bit better. But you look at something like the UK stocks, and like the FTSE was about break even today on this news, and I was like, that's a bit poor. Look at the FTSE 100. The FTSE 100 was actually down today, and I was like, this is depressing. You know, when you get inflation news better than what's expected, and yet you get no reaction on the share price. I mean, or any of the indexes. It's just so poor from the UK. It's such in a depressed state at the moment. You can see why, you know, valuations are so low, and you can see why there's so many acquisitions being happening, because valuations are still low. We've not rallied at all, and whenever we do get good news, they still don't rally. And you can see there's a lot of companies at cheap valuations, and you can see why so many are getting bids for them now, because so many international companies are looking at our markets going, look how cheap that is, we'll go, you know, put a bit of a premium in for that one. It's a bit painful, isn't it, if you're a UK investor? And I guess ultimately, you know, I've said this a few times, but for me personally, I actually keep, I think last time someone asked me on the Patreon and on the Discord, they asked me how much of my wealth's actually in the UK markets, and I think it's 22% last time I checked. So this is a prime example why I actually keep most of my money in the US markets. It's just a lot better businesses, a lot better economy, a lot more growth. The valuations trade at better, higher metrics, and that gives you better returns more than likely. I just personally decide to put a lot of my money into the US market for this reason, and it's frustrating as a UK investor. I still think there's some good opportunities in there, and there's still good money to be made in the UK markets if you can, you know, get it right. You know, when you look at the likes of Greggs and Hollywood Bowl, for example, there's still times to make money there for sure, but it's just it must be a frustrating time. And the third one I wanted to talk about is a sector that I'm interested in. So Kering, I don't know if I said that right. It's a French business. Obviously own Gucci and plenty of other brands as well. High-end luxury business, following the trend of many other high luxury businesses at the moment. Came out with a profit warning, and they said they've seen a lot of weak sales in Asia, I believe it is, or is it China? Yeah, so the performance is notably in Asia Pacific. So yeah, a lot of weakness over in that area at the moment, and we've seen this often, haven't we? A lot of these luxury businesses are getting hurt. 13% drop today, and overall, as you would probably expect, down 33% this year. So you know, one of the sectors that isn't really joining in with the market rally at the moment. And once again, a stock that kind of peaked in 2021 and hasn't recovered. And obviously, the reason why is because the economy was absolutely smashing it in 2021. And you look at a lot of the economies at the moment, and you know, there's a lot of weakness out there, and a lot of them are getting killed off. And I was looking at Watches of Switzerland. I got the classic notification through Trading 212, which, by the way, if you do want to join Trading 212, link is in the description. You get a free share worth up to £100. By the way, someone the other day, oh my days, someone commented on a review I did of apps, and somebody said that I am paid by Trading 212 to promote them. I was like, no, they're just the best broker. Honestly, some of the comments I get in at the moment, I just banging my head against the wall going, why do I do this? But yeah, we got a notification from Trading 212. They said that, you know, Watches of Switzerland was down 5% today, and the downtrend just continues. And once again, high-end luxury kind of business. Obviously, they sell a lot of high-end watches. Mostly, a lot of the revenue comes from Rolex. Obviously, bad update that sent the stock down massively during January. Did have a bit of a recovery, as you can see here, but since then it's been a bit of a dead cat bounce, and the stock's down 18%. And yeah, it's been a tough time for Watches of Switzerland. Same again, you look at the stock, it's had a massive rally during 2021. A lot of companies did really well, and then it's been falling down even more, down 75%. Same again, you get a stock that's kind of really below where it was pre-CV levels, even though a lot of the financials have improved massively since that time frame. If we actually just have a look at Watches of Switzerland, for example, if you look at 2020, I actually go to 2019 because there was the CV numbers in there. Let's just go before the whole CV situation happened. You know, 5 million in profitability, 805 million in revenue. They're now doing 1.5 billion, nearly doubled it up. Profit wise as well, gone up to 113 million. This, you know, it's a lot in a lot better position, but the share price is back exactly where it was. And you look at it in a balance sheet point of view, and the balance sheet as well has rapidly improved since that time frame. The debt has gone from 140 million down to 70 million, so the debt's over halved as well. So the balance sheet's got even stronger. I'm sure the cash pile's gone up as well. Yeah, even the cash pile's gone up. And you look at a company here at 877 million market cap, and the forecast to do, let's call it 90 million, start recovering up to 100 million profitability. They're doing over 10% of the market cap in profitability. The potential for dividends or buying back shares. You can afford to buy back 5% a year of the market cap at these sort of levels, which I'm surprised. I haven't looked at it recently, but I don't remember them doing. I'm surprised they're not capitalising on that a little bit more at the moment. I mean, what's the cash they're currently sitting on? Yeah, 86 million. So yeah, I mean, it's one of those. I'm just looking at this luxury area at the moment, and it's just stock after stock in this luxury area. We had this one today that's down massive, and then you look at Watches of Switzerland, another luxury player that's down massive, and you can understand why they're down, but at some point you got to look at some of these valuations. And I'm looking at like Watches of Switzerland at 7 times earnings, and the profit they'll be throwing off, and this is probably the worst it's going to get. Imagine we're probably going to be in a stronger economy in the next kind of couple of years. And you look at some of these stocks going, when the economy gets stronger, the money's going to be spent back on a lot of these high-end luxury businesses where people aren't watching, the bank accounts and the wallets as much, and making sure they're keeping a bit of cash there. And especially when inflation's coming down and interest rates go lower. So, I mean, I'm looking at some of these luxury businesses and thinking like how much a lot of them are being killed. There's got to be an opportunity in here, and it's, which opportunity do you take? Let me know in the comment section which. I'm sure some of you guys have been looking at some of these opportunities. I know a lot of people played the Louis Vuitton play, which has had a bit of recovery. But is there any other ones that you're kind of looking at? Because I think I've got to be looking at this luxury play as like one that I hold for the next kind of 2 or 3 years as the economy turns around. And one of them's got to do really well. Or a few of them will probably do really well, but it's which one you go for. And I'm thinking I might have a bit of a look into Watches of Switzerland over the weekend, maybe if I can just have another look into it. But it seems like there's definitely an opportunity into this luxury area anyway. So yeah, so that's the video for today, guys, talking about PDD Holdings. Don't say I didn't tell you. The inflation data, and also potentially looking into a luxury play for the next few years as the economy starts recovering around the world. So hope you enjoyed the video, guys. Hit that like button. See you in a bit.